There's an old, simple proverb that contains perhaps the wisest investment advice ever given. Don't put all your eggs in one basket. You understand it instantly. If you carry all your eggs in one basket and you drop it, you're left with nothing but a mess. But if you spread your eggs across several different baskets, a single stumble doesn't ruin your entire breakfast. In the world of investing, this simple idea has a formal name: diversification. It is not a way to get rich quick. It is a strategy to avoid getting poor quick. It is the closest thing to a free lunch in the entire financial universe. Yet, so many investors, especially beginners, ignore it. They fall in love with one stock, one story, one sector, and they bet everything on it. Today, we're going to demystify this foundational principle. We'll explain exactly what diversification is, why it's non-negotiable for your financial survival, and how you can achieve it with incredible ease, even if you're just starting with a small amount of money. So, what is stock diversification? At its core, diversification is the practice of spreading your investment capital across a wide variety of different assets. The goal is simple: to reduce your overall risk. The fundamental logic is that not all stocks will perform the same way at the same time. When one investment is zigging, another might be zagging. By holding a mix of assets, the strong performance of some can help offset the weak performance of others, smoothing out your overall portfolio returns and preventing any single bad investment from sinking your entire ship. Let's make this concrete. Imagine you invested your entire life savings into a single, seemingly unstoppable company like Blockbuster in the year 2000. It was the king of video rental. But then, Netflix and streaming emerged. The story didn't end well for Blockbuster, and if it was your only investment, it would have been a financial catastrophe for you. That is the risk of a non-diversified, or concentrated, portfolio. A single company failure, industry-wide disruption, or a sector-specific recession can wipe you out. Diversification is your defense against this unknown and unforeseeable future. Now, how do you actually build a diversified portfolio? It happens on multiple levels, and understanding these layers is key. The first and most basic layer is diversifying across different companies. This means not putting all your money into just one or two stocks. If you own shares in 20 different companies across various industries, one of them going bankrupt is a painful loss, but it's not a catastrophic one. The second layer, which is even more important, is diversifying across different industries or sectors. The stock market is divided into sectors like technology, healthcare, financials, consumer staples, and energy. These sectors often perform differently based on the economic cycle. For example, during an economic boom, technology stocks might soar, while during a recession, people still buy toothpaste and electricity. So consumer staples and utilities might hold up better. By owning stocks across multiple sectors, you ensure that a downturn in one part of the economy doesn't tank your entire portfolio. The third and most powerful layer is diversifying across different asset classes and geographies. This means not only owning U.S. stocks but also international stocks, and even blending in bonds, which traditionally move differently than stocks. This global and multi-asset diversification is the ultimate risk reducer. For the vast majority of investors, especially beginners, there is a brilliantly simple and low-cost way to achieve instant, world-class diversification: index funds and ETFs. Trying to build a diversified portfolio by individually picking 50 or 100 different stocks is incredibly difficult, expensive, and time-consuming. But with an index fund or an ETF, you can do it with a single trade. When you buy one share of a total stock market ETF, you are instantly buying a tiny piece of every publicly traded company in the United States, from Apple and Microsoft to the smallest listed company. Similarly, a single international stock ETF can give you exposure to thousands of companies across Europe, Asia, and emerging markets. This is the ultimate pro tip. Instead of trying to pick winning baskets for your eggs, you just buy the entire egg farm. You are guaranteed to own every winner, and the few losers in the index are rendered irrelevant by the sheer number of successes. This is why legendary investors like Warren Buffett consistently recommend that most people simply invest in a low-cost S&P 500 index fund. It is the most effective diversification tool ever created for the everyday person. Let's be clear about what diversification can and cannot do. Diversification is not a magic wand that eliminates all risk. It specifically mitigates what is called systematic risk or specific risk, or the risk associated with a single company or industry failing. However, it does not protect you from systematic risk or market risk. This is the risk that the entire stock market will go down, as it does during a recession or a financial crisis. In a major bear market, almost all stocks, and therefore a diversified portfolio, will likely decline in value. But the key difference is that a diversified portfolio will recover with the broad market, while a concentrated bet on a single failing company may never recover. A common mistake is false diversification, where an investor owns 10 different stocks, but they are all in the same sector, like 10 different tech companies. If the tech sector crashes, that portfolio is not diversified. It's still just one basket. True diversification means your investments don't all move in the same direction for the same reason. In conclusion, diversification is not a complex, advanced technique. It is the most basic, essential principle of prudent investing. It is the acknowledgement that the future is unpredictable, and that putting all your faith in a single investment is not investing, it's gambling. By spreading your investments across many companies, industries, and countries, you build a resilient portfolio that can withstand the failure of any single part. The simplest and most powerful way to achieve this is by using broad market index funds and ETFs. Embrace this principle, and you shift the odds of long-term success dramatically in your favor. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. You stop trying to pick winners and instead own the entire market, allowing you to capture the historical, upward trend of global economic growth. It's a boring strategy, but it's the one that works.